Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have our weekly strategy roundtable where we can talk about current market conditions, any questions you might have about your subscription, what to expect short-term and the long-term in the market, some of the trading psychology concepts. For those of you, this is your first live event, do me a favor, type in first. Always want to welcome new subscribers. This is my brief bio. I started Tradespoon in 2012. Prior to that, I worked as a CTO of several publicly traded companies. Options Express is one of them. My passion is in technology. Started Tradespoon in 2012. I want to take this opportunity to say thank you. Because of you, I'm able to do what I enjoy professionally, managing and trading my own money. I've been doing that for over 15 years. Mentoring and teaching subscribers how to trade stock and options. And finally, I have a master's degree in computer science, specializing in statistics and artificial intelligence. Disclosures are very important. Trading stock and options involve risk, not suitable for everyone. You must be aware of the risk and be willing to accept it in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education purposes only. Please consult your financial advisor prior to making any decisions. Also, it should not be assumed the future trade picks will be profitable or equal past performance. All right, let's take a look at the current market. So market was saved by Apple, right? So in terms of earnings, Apple had a stronger than expected earnings, a very volatile session. Pre-market, it was down as much as 5% after announcement, and then strong reversal, and it's now up 7%. So and Amazon is basically the opposite. Actually was down to almost 20% down pre-market, and it has reversed at least 10% of its losses. So very strong reversal in the market. Spiders continue to hold on to this key support level, 380. Right? We talked about this is 38% retracement from high to low from the previous rally, August high, right? And we did break above that trend. So Spiders was able to break above the downtrend. And now it's day one. So the entire week it traded above 380. Let's assume it's going to close at these levels. So that's a big win for the bulls. Despite the Apple, Amazon earnings, despite the Meta earnings or Microsoft earnings. Market continues to go higher, extremely resilient, right? Questions on everybody's mind, I assume, is, okay, maybe market has reached the bottom, right? All the negative news already factored in. Inflation is probably going to slow down. Fed will probably pivot, right? And the market will rally, right? So we have a strong pullback in after ECB decision, right? We pulled back. Same thing in Europe. European yield, strong pullback, broke through the 4% retracement on 10-year yield. German bonds did the same thing in terms of the yield. So with the anticipation, why is the yield down if ECB just came out yesterday and said that inflation is persistently high, we're going to be very aggressively raising interest rates, and we're going to take 1 million at a time, right? Kind of a prelude of what the FOMC, what the Fed will say next week. Why are interest rates down? Well, they're down because, I mean, A, they're extremely overbought, and B, market already senses that most likely Fed, yes, they will raise 75 basis points in November, maybe 50 basis points in December, and then 25 basis points in January, and then they pause, right? They pause and kind of observe the effects of this, pretty strong interest rates rise. I don't know if there's an image. I was looking at the image of interest rates rise during each inflation. See if I can find that image. It was a pretty good image. That kind of compares. Yeah, that's it. Yeah. to the 2002. This is a little bit different chart from what I see, but the idea is comparing the speed of interest rates rising. This is actually, I think, I've saw that it's pretty, oh, it doesn't show 70s and 80s. Where's the 70s and 80s? There's no 70s and 80s. Let's see if I find 70s and 80s. Well, fine. This one, it shows that it is steeper than, 88, 89, 94, 95, 2004, 2015, 2018. But it's, in terms of duration, the duration of interest rate rises and the speed, it's not as steep as it was in 70s and 80s, right? Not in 70s and 80s. So market, I think, senses this, and that's one of the reasons where the market is resilient, right, and trading above 380 level already in the past 4 days. So we are approaching the Fed decision, right? You have a bull argument that they're orchestrating, Fed is able to orchestrate a soft landing, right? We're trading in the range between 380 and 390, right? Basically, we spent a portion of September in this range. We spent portion of October in this range. The question is, after the Fed decision, will the breakout, will there be a continuation pattern, right? Because we did break through the downtrend, right? The downtrend is broken. We're trading above 380 levels. So after the Fed, are we trading above 390, or are we gonna pull back to the lower side? Earnings season, basically this week was the most important week, right? I mean, we're still gonna have a few weeks of earnings, but all of the energy company now announced earnings, banks announced earnings, major technology announced earnings, transportation, consumer staples. We get it, right? It looks like outside of mega cap technology, better than expected earnings, even in some of the small cap, especially small cap stocks. Mega cap technology is, worse than expected, except Apple. But everywhere else, it seems like it's stable. So earnings, I think, already factor in. So it's all going to be about interest rates, right, and perception of inflation, right? CPI, we will have CPI data, PCE data today came in line with expectations. So we're going to have Fed decision and CPI data. So, again, first question is, we do this every week, year end, right? The year end. I mean, there's two scenarios, right? We have Fed, we have CPI. Fed. We have to think about the Fed. We have to think about CPI, right? And we have to think about midterm elections. And looks like GOP is leading based on the recent polls, right? So there is a pretty decent chance that House and Senate will be controlled by Republicans, so you'll have better balance. Right now Democrats control all the branches of the government, not the branches, but the House, the Senate, and the president. And now you're going to have president who is Democrat, and then Senate and the House, which potentially could be Republicans. So those are the events. We're probably not going to trade too long between 380 and 390. I would assume sometime in November, right? In November after midterm election, we're either going to go break to the upside, maybe reach 400, maybe reach 410, right? A pretty decent rally from current level, maybe 15 points. I mean, 5 to 10%, right? So 5 to 10% rally into year end, right? Into year end, 5 to 10% rally into year end. Or, CPI data is harder than expected. Fed is a lot more aggressive. Does not indicate in any shape or form that they will pause and review, right? Right now, market trades on the assumption that the Fed will pause, maybe January, maybe February, and at least start observing the inflation data and potentially not raise anymore. If Fed doesn't say that and say, listen, you guys think we're going to pause, but we're not, because there is no data indicating that inflation, right? And then market, collapses. We have similar scenario we had in September. In September, CPI data in Fed, and I think here, right? Every time, Fed sounds hawkish than everybody expects, then market sells off, right? And so is it scenario one, right, that we're going higher, or scenario two, we're going lower, retesting the lows, which is, maybe 10% to the downside, at least 10% to the downside into year end. So 10% up, 10% down, scenario one, scenario two. I'm gonna pose this question to you guys. One, we're going higher. Two, we're going lower. Kent, I agree. Powell will create volatility. He always does. Okay, so one or two by year end. All right, one. Kevin, okay, thank you for your opinion. One. All right, everybody's one. Nobody's two. That's so interesting. Nobody's two. Okay. So I agree. I think it's one. My opinion, we're gonna, one versus two. Right. My opinion is one. Right. Earnings are better than expected outside of some of the mega cap technology stocks. Stock market is resilient. Interest rates are going down. Dollar is going down. It's all about currency and treasury market. The expectation that the Fed will at least at either November or December meeting will at least say something along the lines that we're going to continue raising interest rates November, December, and January, but then we pause, whatever, 4.75, 5% Fed target rate. Obviously, if CPI is worse than expected and we still have these double digits, instead of going down, it's still 9.5% or 10.5% like it is in Europe, right? Well, then yes, Fed will probably not, will be more hawkish. So, my vote is one, maybe 70% confidence level that it's going to go higher, and maybe 30% confidence level that it's going to go lower. This always can happen, right? There's a lot of geopolitical risk, China, Russia, midterm elections. There are a lot of unknowns, so I don't dismiss this case, but I'm trading with the idea that my portfolio is net bullish, not bearish at this time. Then the second question, most important, is H1, right? First half. The good news, the positive news about Amazon and Meta earnings and Google earnings. Well, now there's no more FANG, right? So nobody talks about Meta or Netflix. But at least the good news about the Amazon and Microsoft is that you already see that the rise in interest rates, the rise in dollar, has significantly slowed down the growth in mega cap technology, and we already see it in Q3 of 02, right? So one has to assume that in Q4 and Q1 it will only get worse, right? And we already know that. So it looks like every book has a story, right? It has a plot, right? This story, this will go down in history with a certain plot, right? Certain events have to happen. So the fact that now in Q3, Google and Amazon already, or Meta already announced, or Tesla for that matter, already announcing that the rate with which they're growing is going to slow down dramatically. That's a good news. That means that we are getting to the final chapters of this book, right? Somebody was asking, like, what inning? Are we in the last inning of? Give me 1 second. right? So if there is, 9 innings, right, in a baseball, right? Is there 9 innings in a baseball? You can tell that I'm not a baseball fan. Okay, so 9 innings, we're in inning number 6 or 7, right? So are we at the end of the bear market? Probably not, right? Probably not, right? That's the hard landing argument, right? So you can have a hard landing argument or soft landing argument, right? So H1 is here, right? The question is, are we going to retrace back to the 350 level? Most likely going lower, right? That's scenario number 2, right? By H1, because we already have a preview of what the earnings will look like for Microsoft and Google and Amazon, right? Most likely it's going to get worse the next quarter, not better, right? Because interest rates are just higher and higher. So is that scenario 2? That's the hard landing argument. Or is it scenario number 1? Fed will pivot, right? Fed will, in November, prior to elections, will come out and say that we're going to pause, right? January or February of next year, we're going to pause the interest rates. We're going to look at the data. CPI data comes much better than expected in November, much better than expected in December. We're already seeing slowing down in demand across all, asset classes. Anything you look at the constituents of CPI, we are slowing down significantly. Even the wages might not, but the rent, the house prices, mortgages, their, used car sales, instead of supply chain issues with semiconductors, now we have a glut, oversupply of semiconductors, right? So CPI will start going down, right? Because there is demand destruction. But the question is how far will how much damage is done to the economy, right? And that's the soft landing. And soft landing will say not a lot, right? Yes, we see signs of revenue slowing down, but the Fed will pause, CPI data will drop, and Microsoft and Google will start making money again, in next year. So H1, do we reach 350 and break through the 350? And I mean significant break, at least 10% break below 350, right? Will we be going back? Let's call it, I don't know. Let's call it 300. No, the 300, 320, right? So 320. Right, 320 level, we're currently trading at 385, 60 points, right? So will we trade, or 70 points, will we trade 70 points to the downside? Or will the bull market resume, right? And we will reach, at least, almost to 52-week high, or basically 20, this year high. So plus 70 points. So minus 70 and plus 70. So H1 is at 1 or 2? 1 versus 2. And Kevin, you cannot say, 3 or 4. I'm just joking. So 1 or 2, 1 or 2 for by middle of next year, March or June. Thank you, Kevin. Thank you. 9 innings. Yes, I knew. Okay, so 9 innings. So we're probably in inning 6 or 7, right? We're inning of 6 or 7 of this bear market. We're not at 9, right? It's not over, but we're we can see the signs of the story progressing, right? The way the story progress, right? First you raise interest rates, then there is a delay effect on the on the indicators, backward-looking indicators, right? Like earnings and wages, right? Wages and employment. Wages, employment are still high. There is no signs of abatement, but in revenue, we already see mega cap technology being affected, right? Growth companies are getting hit by the raise in interest rates. Thank you, Kevin. TJ, can we stay in the large range indefinitely? Well, I don't know what the range you're saying, right? It depends what you define as is the range, right? Let's look at this chart, right? Looking at monthly chart. I mean, you can say we're going to stay in the large range. So one of the right, one of the only stay with we can stay in the range, right? I think would be a scenario of 70s and 80s, right? Inflation. And when you talk about large range, we can say, okay, 250 and 475, right? That this is a decade of lost revenue, right? So we're trading in 475, let's call it a 275 range for the next 10 years, all the way till the end of this decade. That is possible, right? I think this is the worst case scenario. It will only happen if the recession is stubborn and similar to 70s and 80s, where wages are still high, mortgage interest rates are at 20%, right, or 15%, like they were in 70s and 80s, right? And recession is prolonged, inflation is prolonged, right? It's not going down. Then yes, then the argument is that we're going to have a decade of lost earnings, right? Where we're going to do this, this for next 10 years. I think this is a worst case scenario. I don't think anybody believe right now. There's very few people believe in this scenario. This scenario is on the table. I would say it's a, I don't know, 5% chance it will happen, but it's a very unlikely scenario at this point because you just don't have enough data to support this. You can speculate, you can, use your biases and feed into these biases, but there is no data to support that this is what's going to happen, right? So that is possible, right? But that's not the core scenario. The core scenario, right? The core scenario is that yes, we can drop to 275. I believe we will get to 300 or 275 level next year, but then Fed will eventually pivot, actually start lowering interest rates, and then United States is still, best place to park your money, and the economy is going to continue to expand, and we will actually do this, right? And the bull market resumes, right? So that's my core scenario. The core scenario that we will reach the bottom, whatever that bottom is next year, And now with the earnings of Microsoft and Amazon, I actually think it's going to be sooner than later, right? I think we might reach the bottom in, similar to 2008, 2009 cycle where it was in March, right? So, but it topped in October, right? So, 18 months. So 2008, the top was reached in October, and then in March, it reached the bottom. In 2002, 2003, I think, we reached the top in January. So by June, we'll reach the bottom. So my idea is that by H1, we will reach the bottom, whatever that level is. And then that will be the low for the next year, and then in 2024 the bull market will resume. All right, so 222. Yes, stagflation, right? News before, nobody used the word stagflation or deflation, right? Now everybody's talking about deflation, stagflation, right? So, you know, that narrative is going to get stronger. Kevin, yes, the bottom gets put when the Fed stops hiking, right? Fed stops hiking. But if the Fed just pauses, even if the narrative says that, you know, we're just going to pause, well, pause doesn't mean they stop, right? Pause just means that we're going to look at the CPI data and, you know, and then observe. So the core scenario that, yes, they do pause, maybe January, maybe February, but CPI will probably not reach 2%, or PCE will not reach 2% target anytime soon, right? That, you know, everybody thought we're going to get 5%, you know, by the end of this year. We're still at 8%, right? So everything is getting delayed. So if the CPI is going to come in at, again, 7%, November, December, January, they're probably not going to, you know, they're going to pause. They're going to pause, but then they will still continue raising interest rates. Not at the same rate, right? Not at the same rate as right now. Maybe, you know, the rate will start slowing down of the interest hikes. But it's gonna, you know, it's gonna continue, you know, similar to this run, right? Where the duration of these interest rates hikes are much longer, right? And you can see in 2004, 2006, 2015, 2018 interest rate hikes, it takes longer, right? It takes longer, not as steep, right? This is pretty steep, right? But then it levels off the rate of hikes. All right, any other questions? TJ, thank you. All right, how do we help you at Tradespoon? First of all, before we get Tradespoon, what do we do, right? What do we do? We can have worst case scenario, we have core scenario, nobody knows for sure. The idea is that you need to have a trading plan and you need to have a process, well-documented process that you follow, right? So I propose to have in cash, we're only in the best case, we're in the 7th inning. This thing is going to continue for at least 2 more quarters, right? This, you know, it's going to be this quarter, you know, Q1 and Q2, right? For the next 6 to 9 months, we're still going to talk about inflation, stagflation, interest rate hikes, and slowdown in revenue of Amazon and Apple, Google, right? Once the train is, you know, Amazon is a big train, right? Used to be $1 trillion company, you know, or, you know, Microsoft is $1 trillion company, but once the revenue slows down, it's very hard to turn the ship around in 1 quarter, right? It takes several quarters to turn the ship around. So I propose to have 50% of your portfolio in cash, 4 positions, on average to have 4 positions, no, and not risk more than 2.5% of account value, right? When you trade, you look at your stop level and you decide how many shares to buy, and you're not risking more than 2.5% of your account value. 4 positions, 2.5%. It could be scenario 1 or it could be scenario 2, right? By after midterm elections, right? We can break to the upside, we can break to the downside. We're probably going to quickly move 10% up or quickly move 10% down. Kind of similar that we, you know, the rallies we had this year. If you end up on the wrong side of the trade, you do not want to risk more than 10%. So the most is 4 positions, 2.5. I propose in the bear market never be long and short because it's not a one-way trade. You're going to have violent rallies, right? We're already up 10%. We could be up another 10%, similar to June, July, where the rallies are anywhere from 10 to 20%. And we're going to have them every quarter, right? Every quarter, we're 10% up, you know, 15% down, 10% up, 15% down, right? Lower highs, lower lows. So for that reason, I propose out of the 4 positions to have a combination, right? You maybe, right now, I would say maybe you do 3 plus, right? If you said 1, and you think market is going higher, then you have 3 long position, 1 short, maybe 3 long, 1.5 short, right? If you said 1. And if you said 2, I would do 2 plus and 2 minus, right? Have 2 long and 2 short. Right, because market is obviously resilient no matter what, how bad the earnings. We're still above 380 level. You know, there's just not a lot of sellers right now in the market, right? Not a lot of sellers in the market. So then you have 2 pluses and 2 minuses, right? But not all long short. That's where you know that if I was bullish but market sells off, I'm not going to be down 10%. I'm going to be down 5%, 4%. So this is the most important, right? How do you size your positions accordingly, right? How do you size your positions accordingly? And I'm going to go over 2 examples, right? My favorite, the trades, the most popular trades right now, you can find them on Tradespoon, right? Under Elite Circle. Let's go back to, trades that was well executed and maybe not so well executed. So again, there's 2 ways of trading in this market. One, you can do just ETFs, right? You don't want to take individual stock risk, right? I thought Microsoft is going to be great. I was bullish, and their earnings was disappointed. I thought Apple was going to sell off, but earnings were better than expected, and it rallied. So you basically can sell iron condors, right? You can sell premium, right? Everybody talks about small size, selling premium. So this is an example of XLK where I sell premium, right? I sold 118 put for 52 cents, right? I closed it for 13 cents, was able to collect 40 cents. I sold 129.5 call for 56 cents, and I closed it for 10 cents. So 56 plus 53, let's call it $1.10. I hedges, closing positions, another 20, 30 cents. So 80 cents. So I was able to collect 70 basis points, 70 basis points in 1 week on the ETF, right? And the idea, as long as XLK is trading in the range, right? As long as XLK is trading in the range, right, somewhere between 123 and 130, I'm continue collecting the premium, right? Continue to collecting premium and selling out of the money premium. You might say, Vlad, okay, you made $70 on this trade. And that doesn't make or break or change my life, right? But let's say you do this every week and you can collect 0.5%, right, on this strategy, right? So if you can collect 0.5% or 1% in 1 week, right, by doing this weekly, cash secured option wheel, right? You're selling, think of it as selling naked put, getting a sign, selling call, right? So option wheel strategy in 1 week, if you can make 0.5%, then in 4 weeks, you can make 2%, right? And in 12 weeks, right, you can make 24%. So 12 months. So 1 week, 4 weeks, 12 months, right? So 24% in a bear market, you're a superstar, right? So if you're new to trading, or if you don't have a well-defined trading plan, or you don't keep a journal, I encourage you to do the following. Target maybe 0.5% again a week. Trade. You can just trade XLK in this instance. Make 0.5% a week. That's your target, and try to, at the end of the year, beat up 24%. If you can do that, you are, you should give yourself an A at the end of the year, and maybe next year, or in 6 months, once you feel more comfortable, you target maybe 1% or 75 basis points, right? You can see the math. This, you instead of 1 XLK trade, you do 2 XLK trades. So instead of 1 contract, you do 2 contracts, and then all of a sudden, this is 1%, 4%, and 48%. But you need to build this process first, and it takes time, right, to internalize this information. So I encourage you to, 1, always journal, right? You always want to journal. Two, you want to always participate in live trading room, right? You could be a paid subscriber and participate in every live trading room, or you can go on the YouTube, right? You can go on the YouTube without any financial commitment. Right, without any financial commitment, every Wednesday morning bell and closing bell. And as long as you participate in a live trading room, right? So this is the recipe. You journal, you participate in a live trading room, right? You look for 0.5% gain a week, right? By selling these out of the money premium. You keep 50% of your portfolio in cash, right? You keep 50% of your portfolio in cash. You keep, 4 positions at a time. You're not risking more than 2.5% of your portfolio account value per trade. So step 1, 2, 3, 4, 5, 6. If you do these six items, you do them every week at least. Sometimes I understand you can't be in the live trading room. You participate in YouTube. You can participate live, or you can just subscribe and be part of and just watch the recordings. You do this for 3 months. I'm gonna make a claim that your performance will dramatically improve if you did not do these things in the previous 3 months, right? So just pause for a second, do these visual exercises, go back to the previous 3 months, write down how you did in the past 3 months, then follow these steps, and then write down how you did after those 3 months, and just compare the results. I'm going to make a statement or claim that your performance is significantly improved. If it's not, I encourage you to send me an email, tell me what you did before, what you did after, and maybe I can help you figure out, where consistently you're making a mistake. Usually consistently making mistakes is not following one of these 6 steps. Either you have too many positions, or you don't have 50% of your portfolio in cash, or you're risking more than 2.5%, right? Your position size is too big. But I encourage you to follow these 6 steps. Any questions? Okay, so now let's go over some of the good examples where I actually did well, right? So this is an XLK trade. So I did well on the ETF, close, collect the premium, still in the trade, right? When the trade got very close to my short call, right? To the short call, which was 129.5, I bought 50 shares to hedge. So now I'm in cover call, right? I still have stock at 128.13. It's trading at 128.61, and I'm repeating the trade into the midterm elections, right, and into the Fed meeting by selling the 129.5 call. XLK is up 4%. That's impressive. All right, so that's the setup, right? That's the trade. And the size, notice the size, right? Sometimes, you sell 129.5 call, and sometimes it expires worthless, and sometimes it might not expire worthless, right? So then what do? The way to hedge it, you have to buy a stock. So I encourage you, when you trade in options, always, you might have to buy a stock or you might not. That's irrelevant, but you need to figure out the position size, and you figure out position size by translating how much money you're managing. So if it's a $128 stock and I buy 100 shares, right, that is roughly $13,000, a little bit less, right? So I'm managing $13,000. I encourage you, if you have $10,000 portfolio, I think that's okay. If you have $10,000 portfolio, it's okay. XLK is ETF. Maybe the trade will go against me. I'm down 2.5%. I can limit my losses to $250, right? If you trade in, let's say, Microsoft, same example with Microsoft, and the trade is going against me. On a $10,000 portfolio, if the trade goes against you by the stock moves by 2.5% above or below your level, then all of a sudden you're managing, same example, you're managing 238 times 100 shares, right? And you're managing $23,000. And on a $10,000 account, now you have $23,000, you know, and Microsoft moves 2.5% against you or 3% against you. Now you're not down to $50, you're down, you know, $600, $700. So I encourage you to always trade stocks and ETFs or asset classes where when you translate it into equity value, it's always the same size. You always trade around $10,000, right? You can buy a stock for $10,000 if you day trading, right? If it's a short-term trading, you can buy a stock for $10,000, or you can buy one contract of $100 stock for, you know, $10,000, or you can buy 10 contracts, right? You can buy 10 contracts of a $10 stock, right? It's the same, right? If you buy Ford, okay, then you buy 10 contracts. If you buy XLK, you buy one contract, but you always trading in $10,000. I think this is the most important rule, and this is the most common mistake among all the option traders, is that the size, they don't, you know, inappropriate size, right? So, you know, when I traded Apple to, it's not $25,000, it's only in $10,000, you know, $15,000, right? Instead of $25,000. So same thing. I was able to collect 40 cents and 40 cents, 80 cents. I closed it for 10 cents. I collected 70 cents on a $150 stock. I collected 0.5%. And you just rinse and repeat. And you know, one lesson is that maybe I can trade Apple, right, on a $10,000 account, but I cannot trade Microsoft, or I cannot do the same strategy. You know, I can trade XLK, but not QQQ, right? Because one XLK and QQQ will move in a similar fashion, right? XLK is up 3.5%, and let's see, where's the spiders? The spiders is up 1.5%. All right. Any other questions? So I covered a lot of concepts, very important. You know, it's a 50-minute presentation. Sometimes I do talk fast and you're overwhelmed. Main points, right? Usually, especially if you're new to these events, you can retrieve maybe 3 items. I would say number 1 item is education, right? You gotta invest into your education, especially in the bear market. This is not something you can just close your eyes and press button and go, right? You have to invest in education. It's gonna take time for you to figure out how to get, how to risk no more than $250 on $10,000 portfolio. It's easier said, right? You know, I've been doing this for, you know, I don't know, 20 years more. And I still, you know, trade Microsoft where I, you know, told myself not to, you know, not to trade such large amounts, right? So you're always going to make mistakes. It takes time, right? So education, I encourage you to participate in live trading rooms. You can do it as a part of the service, Elite. You have access twice a day, or you can do it for free on YouTube, you know, once a day. But you invest in your education. This, you cannot, there's no way to bypass this process. Some people think, you know, I can have a full-time job, you know, sign up to alerts and just, you know, I get an alert and I press the button and I make money. Maybe in the bull market, right? You buy and hold and okay, you don't have to spend a lot of time. In the bear market, you have to, you know, it's not, doesn't have to be a full-time job, but every day you should spend at least half an hour a day learning, reading, understanding, right? Or following, you know, my, you know, newsletters and following the trades. So invest into education. If you have full-time job, just watch the YouTube recordings, right? We make this very available and easily accessible. Remember, cash is a king, right? Find the appropriate level for your positions. And it's always about position size, right? And to me, position size is very simple. right? It's number of positions times position size, right? 2.5% of account value, making sure you're not breaking 2.5% account value rule. It could be 2%, it could be 1%, depends on your background, but that is a very important rule. So I encourage you to participate, to think about these three items. Then, journaling is important, understanding iron counters important, how to hedge your positions. There's a lot of concepts that are important, but these are the foundations of the trading. So yeah, I encourage, we do have a lead circle. This is something you can join, right, and participate. We do have other services like Stock Forecast Toolbox. If you've been part of the live trading room or you watch my video or watch the blog, I always use this tool. Very accurate tool, helps you navigate the current volatility. It doesn't know about Powell, it doesn't know about ECB, it has no idea about midterm elections. It looks at the price, it looks at the volume, right? And it basically says the way market is trading right now, we're definitely in uptrend, even though it didn't know about Amazon or Apple earnings. And 380 is your support, 390 is your overhead resistance. Based on the current momentum, we are trading between 380 and 390 range. In the next 10 days, potentially we can get to 400 level, right? Going into midterm elections, if the market is going to be around 400 or 405, don't be surprised, right? And then you can zoom out, right? You can zoom out into 6 months. And basically the story changes, right? We're still trading in a negative trend, but we get to 395, right? So you have to kind of reconcile these two indicators, right? A lot of people open support ticket that says, Vlad, this doesn't make sense. Why would the spiders be down in 6 months, but up in the next 10 days? Well, that's just the way how market works, right? And that's how the model works, right? Model analyzes, for 10-day prediction, it analyzes, past couple months. For 6 months predictions, it analyzes past couple decades, right? So you can have a situation where you can be up in the next 30, 60 days, and then we can be down in the next 6 months. Most of the new traders don't think like that. They think binary. We're either going higher or we're going lower. But markets never trade in one direction. They never do. So that's the Stock Forecast Toolbox. I encourage you to consider that. If you want to follow the portfolio and follow my trades, then yes, Elite Trading Circle, Shadow Trader, Spread Trader, Premium Portfolio, Robo Investor. These are different types of portfolios. Some of them are stocks, some of them are options, but help you, navigate current market volatility by getting SMS messages and access to the portfolio. All right, any other questions? Meanwhile, pretty impressive rally. I actually thought we're going to collapse yesterday after Amazon and Apple earnings, when Apple was down 10% and Amazon was down 20%, but impressive recovery, right? Impressive recovery. QQQ is up 2%. Where's my friend? Amazon down 10% and Apple is up, almost 8%. Very nice trade. And NOC is up 4%. Continues to rally. Okay, any questions so far? Right, if there are no other questions, that's all I have for today. Thank you very much. Again, remember those 3 things, participate in live trading room, don't trade by yourself, commit to 3 months, keeping journal and watching the recordings. I think your performance will improve significantly. I believe, not only think, I believe, otherwise I won't be here. The second is cash is a king, 50% of your portfolio considered to be in cash. And the third, it's all about size. Size. Trade small, trade often. You hear this expression, almost everybody says that. It is easier said than done. You gotta practice, right? Like, I can show you Chess openings, are you going to be a grandmaster in chess opening? No, you probably have to practice it. I can show you some moves how to ski. Will you be able to go to Colorado and ski from Black Diamond? Probably not. I mean, you could, but you're going to fall a lot, right? So if you want to avoid falling a lot, invest into education. We do have coaching program. You can participate in live trading room. You can open up support ticket. You can schedule one-on-one consultation, but invest time and effort in education. Thank you very much. Have a great day. Have a great weekend. Huge win for the bulls. I actually thought, after the close that market is just going to fall apart. It did not. Bulls should be celebrating. And hope to see you. No closing bell today. There is no closing bell today. But Monday, I will see you bright and early. Thank you. Kelvin, thank you. Trader, thank you. Mark, Tom, thank you. Abdullah, thank you. Bill Dudley, thank you. All right, everybody, thank you very much and have a great day.